What's up, everyone? Today we're going to be talking about OPRA stock, the stock that I mentioned in the last video. We talked about how it was potentially undervalued because of its shareholder friendly management and impressive earnings growth in the past. So we will be having a little update on that. And the second part of the video, we're going to be finding some more stocks. Uh, I found a little bit more clearer way, step by step, that we can do such a thing, and we will be going through these. So, the first step to do this type of analysis that we're going to look at today are finding undervalued stocks by looking at recent sell-offs. Finviz is a great website to find this. You can sort by performance of year to date, 6 months, 1 year, even all-time and 52-week highs and lows. You can also check Wall Street Journal. Wall Street Journal posts 52-week highs and lows every single day for updates. So that's a great way to find sell-offs in the stock market. And the last websites that we may use, Macro Trends, SEC, etc., for finding financial statements and confirming information that we find with financials. So step one, we will filter by size, seasonality, and strong franchise. So what that means is finding a business that is recognizable, pretty popular, large in revenue, and large in market cap. So at least over $2 billion in market cap. Number two, identify those with little or no direct competition that I know of. So that will be meaning I will find companies that do not exclusively exist. So there are companies like Nike and Adidas that can exist together because people buy multiple shoes at once. Where one Nike customer will not necessarily take away business from Adidas and vice versa. On the other hand, you could talk about phones as direct competition. Apple has direct competition with a company who makes phones like Samsung because people often don't own two phones unless they work for the CIA or they're James Bond or for whatever reason I can't think of. But most people don't, and so that means that any Apple customers will take away potential Samsung customers and vice versa. So that's what direct competition is. And when direct competition happens, and there's a lot of it can be harmful for your margins because you're not always going to be able to sell your product and service for as much as you want to sell it for. That was a long explanation. But number three, identify those that diverge from their industry and stock performance. So that's great for comparative analysis. So if you see a stock that's, let's say, in the AI industry, and the AI industry has experienced major growth and is super bought up and overpriced, and this stock has been left by the wayside, well, it may be because they suck, or maybe because they're undervalued. So that's a great place to look. Determined shareholder friendliness is number four. This is something that is sought after by Buffett and recently sought after by me. It's very important that the management be distributing value back to their shareholders, and they can do that through three ways. Two ways I have down here, which are dividends and repurchases, and you can easily find that out by looking up the dividend in their financial statements or looking at their shares outstanding and seeing if they're going down over time, which may allude to the fact that they have a repurchase program in place. Just to review, a repurchase program is returning value to the shareholder because when there are less shares outstanding, the value of each share goes up. The earnings per share goes up. The third way, though, that is not mentioned on this number fourth point is that companies can invest into their brand to grow it. And when you are a shareholder, growing the brand means more profits, and that just means greater earnings, greater stock price, greater dividends, an all around very good thing. So, the third is investment into growing the brand. And number five, analyze past revenue and quarterly and annual net income for stability and growth. So if revenue and net income is growing in the past and the quarterly net income shows relative stability, where you can expect that the company will remain in positive earnings, and there won't be any major deficits with a giant drop and a giant increase and then drop again. That can be a roller coaster when you're holding a stock like that, and it's also just not, it's kind of frowned upon by the stock market, and usually the companies that have more stability will be more likely to be more long-term good investments. Number 6, calculate a normal earnings in PE. So using the data that we found in number 5, now we can see an average. So what can we expect this company to make in a neutral business prospect world? One where there isn't an exceptional year in the industry, one where there's an exceptional year in the company. What's its normal earnings? And it could be positive or it could be negative earnings, but what is that? And PE ratio is the price over earnings. So what you can do to calculate PE is find first the earnings per share. So once we get the normal earnings, you divide by the number of shares outstanding. So earnings over shares outstanding. And PE ratio would be the price divided by, the price divided by that number. So say a stock has $10 per share. It says $10 on the stock market, and its earnings per share that we calculated is 5. It would have a PE ratio of 2. And PE ratio of 2 shows it may be very undervalued, potentially, as long as the other aspects of it are positive, are optimistic. And usually you don't want to pay any more than 20 PE ratio. You don't want to pay, say, only a stock that is paying $40 per share with earnings that are only paying $2 per share. That's a risky play, especially in a high interest rate environment. Number 7, calculate a return on invested capital with that number. So invested capital, just to go over the formula, is current operating assets. So that is current assets that have lives of 12 months or less that are in operations actively. So not necessarily excess cash or marketable securities or investments, but things like receivables and what's another good asset? Prepaid expenses is not an example of something we would use, but it'll go case by case, so we can find that out when we get to it. But a return on invested capital, once you have that current operating assets, you subtract the non-interest bearing current liabilities, so liabilities that have a 12-month or less lifespan and that must bear interest in order to hold. So that can be deposits, which must have savings rates. There can be leases, which must have certain interests, and loans, any types of loans that you have to pay interest on. So bonds included in that category. And a return on invested capital gives you an idea of how capital light or capital intensive the business is. And if it is capital light, that is positive, and capital intensive, usually it doesn't perform as well in times of recessions or macroeconomic negative events. So I would avoid capital intensive businesses. And that usually runs in the range of 10% ROIC, return on invested capital, or less. And return on invested capital just means how much is earned as a percentage on their invested capital. Number 8, compare margins against competitors. So if, say, there's a company that has growing margins in the past and it is at a margin that is much lower than the industry, that shows that there's potential room for growth. I can cite an example of Weetabix, which would have been an incredible investment in around the 90s or so, because they had growing operating margins and their operating margins were much less than their industry competitors. So over time, as their operating margins increased, you were the beneficiary of that as a shareholder. Finally, calculate balance sheet and asset values, including working capital less inventory, shareholders' equity, tangible cash and current asset values, and liquidation value to determine how conservatively valued the company is. So that will tell you a whole lot of information about the different ratios that and proportions that you can set on property, plants, and equipment, goodwill, intangibles, cash, investments, and all sorts of other things, and also on the liability side, to determine whether the company is truly undervalued. Not everything is about the earnings. Some of it may be as the company has value as just the assets, just what is sitting in the bank, or what's assets are in operation, what capital is being used, and that can tell you a lot about what it would cost in the private market. Let's say if someone were to buy out a company, what would they pay for it? Well, in certain cases, they would go very much by the earnings, but in most cases, they go by the liquidation value. So that'll all depend on what is in the balance sheet. The balance sheet also includes things that are very tied in with the earnings, which includes retained earnings and additional paid in, which is the proceeds from the sale of additional stock over the par value. But in this specific 9-step process, we won't be going over retained earnings. That'll be saved for a much deeper dive into whether a stock is undervalued or not, as well as that goes for the additional paid in. So, to get back on our agenda, I want to first talk about OPRA stock. So, recently I was a little bit disappointed because I thought that they had a 6% dividend, but in reality it was more like 2%. And the way that I came into that conclusion was by not checking the explanation of their dividend on Google, but rather looking at what it really said on the financial statement. So if you go to OPRA, there we go, OPRA, the web browser, in my opinion, a good product, good service that people like. Nevertheless, you still have to analyze its financial statements. So financials, quarterly results. I'm also going to go to the SEC. Great, reputable website. I type in OPRA. Then I'm going to click annual report. The most recent one is reporting for 2023, filed in 2024. I'm going to scroll down a little bit to the table of contents, press item 17, financial statements, and I'm going to go straight to the cash flow statement, because the cash flow statement is where you'll find the dividends paid row under the cash flows from financing activities. Then I'm going to go back here. I'm going to look at their most recent quarterly result, not their annual, but quarterly, which is from today. Just a side note, their stock went up quite a bit today with their press release. All right, I'm going to go to their cash flows to look just at the same dividends paid. And I'm going to leave it at that. So, on Google, if you look up OPRA stock, you'll see a dividend yield of 5.5%. Well, I looked at that yesterday and was very surprised, happily, because that's a great sign of a shareholder-friendly management. That is one of the criteria on our stock undervalue analysis sheet. However, in reality, it is not 5.5%. They have a semi-annual dividend distribution, which means it's not every quarter, but only 2 out of the total of 4 quarters in a year. And so this explains why in 6 months ended June 30th, all they paid out in dividends was $12 million and $9.8 million, respectively, in 2023 and 2024, 6 months ended. That does not point to a 5.5%. Going by those numbers alone, you're looking at this year's of 9.8 million divided by the total market cap of 1.28 billion. So that's going to be in this 1 to 80. That is 0.7 dividend percent yield, not 5%. So that's going by 1 quarter though. Now if we want to look at the annual, which is only possible for 2023 because 2024 hasn't had an annual statement yet. Dividends paid you see as 23 million total. 23 million can be just fit in right there to get the yields over the price, the market cap, and you have a 1.8% dividend yield, not a 5.5% yield. So how did they get to such a high yield? Well, the reason is because it seems like Google went just by what the company claimed that they were paying out, but they didn't dig a little deeper into what it actually meant. So if I control F dividend, and I go to the first mention of the dividend, it says OPRA declared a semi-annual dividend of 0.40 dollars per ADS, which is American Depository Share, which is the share that they put up on the NASDAQ because they are a foreign company, and represents a total dividend value of 35.4 million at the July record date. The cash distribution was 27.6 million, where the remaining 7.8 million was offset against a receivable from the sale of Star X, resulting in the receivable being fully settled. So if you just go by this line alone, 40 cents per ADS, and as this price represents the price per ADS, well, this will give you 0.4 out of 14.5, which is 2.6%. And this is a semi-annual dividend, which means in reality that the year dividend would be 80 cents per ADS. So I'm going to change this to 0.8 because there's 2. Oh, that's interesting. Now you get 5.5%, which is what Google says. This is a wrong way to go about it because they pay out most of their dividend, or a large portion of it, not to the normal shareholder like you and I, but via non-cash, via stock. You can actually see this when you go to their financials. If you scroll down a little bit past their balance sheet, you'll see dividends in their changes in equity. Well, you may be thinking, why would dividends be in changes in equity? Because dividends is just cash, right? Well, in this case, it is not just cash. It represents stock. They actually paid dividend in stock. So part of that number, I believe to be a stock dividend. The other part of that number, and let me just go back real quick to show you again. There we go. If you look on the quarterly results, this is what it shows. As of January 1st, 2024, they paid 35 million in dividends, and that decreased the equity. So that means that it seems that they were paying stock dividends to something. I don't know what it could be, but that's decreasing the dividend that they claim at 80 cents on the dollar extremely. I'm going to show you one more thing that was very interesting. This is what I do often with financial statements. It's just Control F, Command F. There we go. So this is they talk about the dividends payable to Kunlun Tech Limited which is a subsidiary of Kunlun Kenai's Future Holdings, and each a shareholder in their company. So it seems that they pay a large percentage of their dividend to this company that owns a bunch of them called Kunlun. It seems that they sold 19.4% ownership interest in Star X, I'm guessing another subsidiary, to Kunlun recently. And that is being taken out of the dividends that they owe to Kunlun. So, in short, there we go. The remaining 25.1 million of each distribution that relates to ordinary shares and would otherwise be payable to OPRA's majority shareholder, Kunlun, boom. So it says these were offset recently because of the sale of investment. That's a non-recurring charge. So in most cases, it's going to be payable to the majority shareholder, Kunlun. And that settles that. It seems that OPRA stock does not truly have 5.5% dividend yield. And I didn't even need a long explanation for that. All I have to check, and all you have to check to doubly make sure of the dividend you're going to receive, is go to their annual statement, go to their cash flows, go to the dividends paid, and the total will tell you the yield. And the yield you will calculate by taking the total divided by the market cap, and make sure it's in the correct unit, so in this case millions, and boom, 1.8%, not 5.5%. So with that information, this stock does not seem like an investment worthy stock because they're not as shareholder friendly as I thought they were. All right. First part of our agenda is complete. In this next part, I'm going to be going on finviz, and I'm going to check what are some of the lesser performing stocks on the stock market, and we're going to find some undervalued stocks there, hopefully. As it's loading, I can also try to do this. I can check out the Wall Street Journal because sometimes that will show good companies in the lows, the 52-week lows. I hope it's not laggy on your end. There we go. Okay, so scroll down, new 52-week lows, only 16. We got Agilon Health, Arch Resources, Compass Minerals. Are these any companies that you recognize? That's the first question. Shutterstock, I recognize. Agilon Health, do not know that one. Arch Resources, is that something? Coal mining. DHI Group, don't really know this one. John Bean Technologies, isn't that a liquor? Automated vehicle company, never heard of this. So even this is kind of not very scientific, but this is necessary. Sometimes you only want to look at the stocks that you know of because that'll be good examples of ones that are strong franchises. Lee Cycle, Compass Minerals, International. Never heard of it. Wow. It's also low market cap. Shutterstock, Noble Corp. Okay, I've never heard of this. A drilling company. And Shutterstock. I'm just making sure that Wall Street Journal knows what they're talking about. Yes, they do. It is very low. Okay, that's a good example. We can start looking at that. Pros Holdings, I've never heard of any of the other ones. A lot of these holding companies are usually fishy. Digital Bridge Group, maybe. Kind of sounds like a real company. No, it's an investment firm. Infrastructure. Great. Okay, Shutterstock it is. So, and you can also check by the volume. If it's a lot of volume, sometimes it means it is a company of note. Okay, I'm satisfied. So we got Shutterstock. So let's take a look. Shutterstock, what is the first step on the list? So is it a large company? Well, 1.1 billion market cap, that is smaller than what we thought, but they have revenue of almost $1 billion. So that is a pretty large company. And this is well known. A lot of people know of Shutterstock. So, pretty seasonal business. Number 2, identify with little or no direct competition that I know of. So, let's look up Shutterstock competitors in stock photography. Adobe is a very, very big one. iStock, okay, there's definitely a bunch of websites. Canva. Yes, do people use many different stock photography websites? I have no doubt that they do. But do they have subscriptions to multiple? That's probably less likely. So it is relative direct competition with Adobe. So I'm going to say yes, they do have a very formidable competitor in the direct competition area. So that's not good. Number 3, identify those that diverge from their industry and stock performance. So let's take a look. Shutterstock. Delete this one. Shutterstock stock. Adobe stock. This will give us a very good idea. Adobe has very much outperformed Shutterstock. I'm going to look up stock photography companies publicly traded. Getty Images, is that publicly traded? Really? It is. It has not performed very similarly to Shutterstock. iStock, stock. All the stock is getting, oh, it's owned by Getty Images. Good to know. Pixabay, Repic, Alamy. Okay, well, we got 3 pretty good ones: Shutterstock, Adobe, and Getty Images. So it isn't really diverging that much from the pack. Determine shareholder friendliness. Are they friendly people? We're going to look up their name in macro trends. We're going to just click one of these so we can get redirected. We're going to go to financials. We're going to scroll down and press shares outstanding. Voila. No change. So they're definitely not repurchasing their own shares. That's 1 down. Are they paying a dividend? Drum roll please, drum roll please. They're paying a 3.66% dividend. Okay. Good to know. Well, they are paying a dividend. 3.6% is not bad. It's definitely not even close to the risk-free rate like the T-bills are, but 3.6%, that's something. Now let's analyze past revenue, quarterly, and annual net income for stability and growth. We're going to go to financials. We're going to go to net income quarterly. So we'll show the quarterly down here. Okay. Woo. So it's kind of a roller coaster. Since 2020, they've definitely had a pickup, but also a slowdown since the peak in 2021. They had a big spike in 2023 and then a deficit in year-end 2023. Interesting. A little bit unstable. We're going to look at the revenue. Revenue quarterly. Growth has definitely slowed down. You can see year over year. But it is growing, albeit at a slow pace. We're going to look at annual net income. Very impressive growth. Mostly since 2020. Nevertheless. All right. Calculated normal earnings and PE ratio. So, can we trust their current earnings? Are they having an exceptional year? Let's see. I'm going to put them in here. Adobe, their friends, Getty. I'm going to put them on multiple axes. All right. Getty had a big drop. Adobe had a large increase. This is from 2012. I'd say during 2021, they all experienced pretty major growth. So, are they having an exceptional year? Potentially. Potentially not. That is to be seen. So let's move on. Calculated normal earnings. I'm going to go back to financials. I'm going to go actually to their net income quarterly and calculate it manually. So let's look at this. So it's sort of hovered around this $5 million mark, and it's currently at $5 million in its most recent report. But during COVID, it shot up to almost 30 million, more than that, 50. So if we were to go and measure just the exact midpoint between them, that would probably be misleading because it's not necessarily going to be elevated at those levels forever. However, if we go somewhere a little bit closer to the 5 million mark, say 10, that could give us something that's a little bit more accurate. So let's do 10 times 10 times 4, which will give us 40 million because there's 4 quarters. And let's compare that to their net annual statements. 40 million, does 40 million look right? It's definitely nowhere near 100.1 billion. Let's give them benefit of the doubt and we'll go 0.7. We'll start with this new era of net income, the bottom of this new era. So 0.07 billion, which is the same as 70 million. All right, so we have a normal earnings of 70 million. Calculate a return on invested capital with that number. SEC, Shutterstock. Most recent quarterly report. Now let's do some calculations. Current operating assets, not including cash, does include receivables, prepaid expenses, and other. What does other current assets mean? Has a receivable of 43.7 is against an escrow fully funded by Meta. 31.5 million. Okay, that's interesting. All right, I mean, it seems like we can use this number, that it is receivable. But is it an investment receivable? That's the question. Assets required in thousands, 1.2 million with Giphy. Oh, okay. Operative, no. So it wouldn't be operative because this company often wait. It is an acquisition-based company, so it would be operative because this is mostly from their acquisition of Giphy, and Shutterstock does make acquisitions in the past, so most likely this would be put into the operating assets. So I'm going to use these bottom two rows. So this is going to be 97.4 million plus 68.5. Okay, that's current operating assets. I'm going to put that in brackets just for presentation. Then I'm going to subtract the non-interest bearing current liabilities. So that's going to be payable, accrued expenses, royalties payable, deferred revenue, not debt, and other current liabilities. We're going to see allowance for chargebacks. Since we don't know, I am going to include it because it will make it a little bit more conservative. So let's do it. And non-current, deferred tax, these are all non-current, so we would not include these anyway. So this row, this row, this row, this row, and the bottom row, but not debt because they pay interest on debt. So first number, 10.5 plus 96.9 plus 65.7. I'm not actually doing plus, but I put it in parentheses and there's a minus on the outside. So it's the same thing as saying minus each time. Plus 42.6. We're going to do one more bracket for the property, plants, and equipment, intangibles, and goodwill. These are other assets that are used for operations. So 63 in property, plants, and equipment. Right of use assets, that's things like what buildings they're allowed to use for their business. Intangibles, 164.5. Goodwill, 403. And deferred tax assets does not be operating, and other assets, I'm going to see what that is. For certain unbilled receivables. Unbilled receivables. Oh, okay. Well, that is an asset. So 31.9 million out of the 93 are actually operative assets. This has consumer retained financing. Okay, looks like there's more money and other assets that can be used. Equity instruments, that is not included, so equity instruments is not an operative asset. Okay, so it seems like they have an extra 31.9 plus 38, 31.9 plus 12.6. So I'm looking right here, and I'm looking right here. So 12.6 plus 31.9, that will cover the other assets part. It's a good thing I checked that out. It's okay if we're not exact, but we'll be exact just for the sake of the video. The reason why it's okay if we're not exact is because we're supposed to be looking for a margin of safety. So it's a broad range of undervalued area. So this is the total invested capital of 646. And what did we say the net earnings were? The average was 70, right? So 70 over 646. We're being conservative. This is 11% return on invested capital. Not very good. And if we do 0.1, which is their current earnings, oh, sorry. millions. Wait, what's going on? Oh no, it should be 100. Sorry. 15%. Still not very good. So this company has kind of a lower end of return on invested capital for, just being a software company. This is not very high. Usually you want to see even above 20%. For a benchmark, I have investments in Ulta Beauty and they have over 20% and they're a retail company, so I have no business investing in Shutterstock. Maybe you do. Compare margins against competitors. I'm just going to do it for the laughs and giggles. But just because of that disappointing return on capital number, I'm not going to consider this one. Operating margin. Shutterstock on the lower end. Oh wait, single axis. Yes, definitely the lower end, but has not experienced that much growth. In fact, it's mostly been decline. Adobe definitely experienced growth, so that explains their height. But Shutterstock does not look like to have much prospect in the way of growing their operating margins. Neither does their other competitor, Getty Images. All right. I'm just going to skip the calculate balance sheet and asset values for this stock because we aren't even going to get that far. It's not undervalued whatsoever with the return on invested capital. And, we didn't even calculate a PE for it. If we use our normal earnings divided by 70, so that's the market cap in millions, 1.16 billion is 1160 million divided by 70 million. Is 16.6 PE ratio. That is the same as saying a yield, so you just switch around the numbers, a yield of 6%. As if saying, with each share you get 6% of it is earnings. Yeah, and especially that is 2.4% higher than their dividend. So they're withholding 2.4% of their earnings from you, the investor. All right. Just for education purposes, and because I'm a little bit uncertain now, because that's not a horrible earnings yield, I'm going to check out their balance sheet. Do they have a conservative balance sheet? Let's find out. I am first going to look at their tangible asset value. No, I'm not, actually, because most of their value does not come from there. First, going to look at their liquidation value. Are they better off as a going concern or to be liquidated? Let's find out. So 75 plus, so this is how you do liquidation value. Take the cash just by itself. Then you take the receivables, but you multiply by 80% of it because during the liquidation, only about 80% would be recoverable. Prepaid expenses and other current assets are not included in the calculation. Then you take that number that you just got with this plus 0.8 times this, which is 152.6. You take that and you subtract the current liabilities at 432, rounded of course, and then you finally add 0.2, 20%, which is because it's only slightly recoverable, the following. 0.2 times total assets, which is 1,003 millions, minus 241 millions, which is the current assets. And that will give you this section right here times 20%, because about only 20% of the goodwill, property and equipment, things like that will actually be recoverable in the event of a liquidation. And it looks like you still get negative liquidation value, which is not very impressive. I'm going to look at one more. I'm going to look at the current assets minus current liabilities. Pretty easy. That'll get you the working capital. Ooh, they have negative working capital, which means they have more liabilities than current assets, which also means that the company may be in deep doo-doo. That in 12 months or less, that they are insolvent, according to the balance sheet. Just that alone usually means that I won't invest in a stock. So even though, they have a 16 PE ratio, and that's not incredibly high, that bad news just did it in for this stock. So Shutterstock is no bueno, and I'm going to close Wall Street, and I open finviz. How am I doing on time? I'm going to do a couple. I'm not going to go crazy. Because Shutterstock was a pretty long example. All right. So this is a really great tool. I love this website. I'm going to stand up. It's a great tool because the filter has so many different options, and it's free. Love free stuff. The thing is ads, but you can always just press the X. All right. We're going to put in some filters. First of all, I want a current ratio over 1.5. That goes back to what we just found with Shutterstock, which was that the current ratio was below 1, which means there was more current liabilities than current assets. And if I say over 1.5, then we'll most likely find companies that are more solvent. I'm going to put quick ratio. I'm going to set that. I'm not going to do anything with that. I'm going to put PE ratio under 20. Because that's the recommended max PE ratio by the authors of Security Analysis. Then I'm going to put market cap over 2 billion. So this will find companies over 2 billion in market cap. I'm going to put IPO date more than 5 years ago, because I don't want to find companies where I don't have any financials to look at. I'm going to actually set this current ratio over 1, just to be a little bit more forgiving. And the technical part is where we can find the sell-off. So there's performance figures. You can see today, week, month, quarter, year to date. Year to date just means the first of the year today. To today. I'm going to ignore these. I'm not a chartist. I'm not a day trader, but all-time high and low looks interesting. What if we put in 20% more? Okay, that gets us 215 total tickers. What if we did even more? 40%. Okay. Let's start with 40% lower than the all-time high or low. Not bad at all. All right. This gives us a long list of stocks, about 131 stocks, 7 pages of them. And also for this video, I'm going to set it all to the US, because foreign companies may often, The pickle about foreign companies is that they don't always have the most up-to-date stock information, the most accurate stock information, and they're sometimes much more volatile and unstable than U.S. companies, just by the nature of their economies versus our own. I'm not being patriotic, that's just the facts. Usually you want to pay much less for a foreign company. So that explains why, Spain has a P ratio of 6, while PayPal has a ratio of 17, and so forth. I'm first going to look at and sort by industry. I'm going to see if there's any outliers, any stocks that just are from one industry and they're kind of here and you don't really know why. John Bean Technologies. So that's the first stock that we've come across where this is the only one it's in its industry, industrials, that is 40% below the all-time high with all the stuff that we put in as well. I'm going to check it out. We're going to be a little bit more strict. We're not going to go through all the steps because it's not necessary if the first steps don't go through. Shares outstanding. No change. Let's hope for a dividend yield of some sort. 0.46. So, all right. And just because I know that for OPRA stock, I got very misled by the dividend that Google gave me, I'm going to check their last 10K to ensure that Google is telling me the truth. I'm going to put in financial statements. I'm going to go to their cash flow. I'm going to look at the dividends, and they paid 12.8 million. No, yeah, 12.8 million in dividends. I'm going to go to their stock price. I'm going to do 12.8 divided by 2760, which is all in millions. That's their market cap, this number. This will give me the dividend yield, 0.4%. Google says the same thing. So, this stock is no bueno, and because it is not shareholder friendly, that is the reason. It does not return enough value back to the shareholder. Semiconductors, there's a bunch of those. Restaurants, semiconductor equipment, recreational packaging and containers, Sealed Air Corp. Let's check out that one. It's a lone wolf. Okay. Promising decrease in shares outstanding. Do they pay a dividend? And they pay a 2.3% dividend. Okay. Let's check this one out. So, is it sizable and a strong franchise? Well, it has a $5 billion market cap, quite large. Revenue of $5 billion as well. Let me see if I recognize any logos. Food packaging. Let me go to Google Images. Not really. Don't really recognize them. But by their revenue and the market cap, they seem like a pretty large company. So I'm going to go to the next step. Identify with little or no direct competition. So what are some potential competitors? Reason why I want publicly traded is because they usually will have financial statements. I'm going to look at Grief. I know that's a stock. I've heard of that one before. Barrels. Okay. Well, this is fairly similar. So I'm going to see NYSE ball stock. Home canning. Okay. Pretty direct competitor. Yeah, I mean, it seems like in the industrial industry, they would definitely have, over the whole industry, they would definitely have multiple people doing their packaging, but a single company would likely have one company doing their packaging, just for cost purposes, unless they have multiple different products. But either way, they would probably have one that did it anyway, all for them. So, definitely has some direct competition. with all those companies I just looked at. Determine shareholder friendliness. So far, it does look pretty shareholder friendly. But does it diverge from their partners in stock performance? Well, let's see. We found Grief. Nope, Grief has pretty much stayed up top, even though this is pretty low. Ball. Huh? Same story. Okay, so not that set apart from its group. Okay, we're going to end it off with that, and then we're going to say what the next step is. Analyze past revenue, quarterly, and net income. Are they growing? Are they stable? These are the questions. Quarterly, not growing at all. In fact, kind of in decline for the past few months. Net income, also not very stable, not growing either. Now I'm just going to look at their cash flow, their net income annual. Yeah, they haven't really grown much at all. If I were to give them, let's say now, normal earnings, this is at 0.5, this is at 0.3. I'm going to just use their most recent earnings and say 0.3. So 342 million. I'm going to go and find their earnings per share. Shares outstanding is 145, so 342 over 145. Here's the earnings per share of 2.35. And then price per share is 34.5, so I'm going to do this. 0.6 divided by answer, earnings per share. That's high. For a stock that hasn't grown, 15 is saying that it has pretty good prospects of growth, that it's better than neutral, and neutral is around 12. Seems very undervalued on the earnings standpoint. I'm going to say no to this one because it hasn't had much growth, kind of depressing, and kind of overvalued in terms of the PE ratio. All right, let's see. Any winners, guys? MGM, Wendy's. Wendy's is kind of random. Are they shareholder friendly? Let's see. Okay. Relatively, do they have a dividend? They do, and it's 6%. Not bad at all. Okay, let's check out Wendy's. Size, seasonality, and strong franchise. Well, I know a little bit about Wendy's. They're definitely large. Market cap 3.4 billion, revenue 2.1 billion. Yeah, they're definitely a reputable, large, recognizable company. Those with little or no direct competition. Does it have direct competition? Well, I can think of some of their competitors. Wendy's competitors, like McDonald's, Yum Brands, Burger King, Taco Bell, all the KFC, all those places. Yeah, they definitely do have direct competition because a McDonald's customer can take away from Wendy's. However, they don't, because people have multiple meals, and so they may go to different restaurants. So no direct competition, but they do have large competition in general. Shareholder friendliness is not bad. Do they diverge from their industry and stock performance? Not McDonald's. Not Yum Brands. Not this. I know of this one as well. Applebee's and IHOP. Yeah, Applebee's and IHOP also has been going down dramatically. So, relatively pretty away from the pack. Question is why. Now we're going to analyze their past revenue. Has been growing since 2017 gradually. That's not bad. Quarterly. It's been slowing down though, past few years. And it also had slowed from previous years, about 10 years ago. Net income seems like it has actually been growing, and it's pretty stable. Who knew? Maybe Wendy's is it. Definitely grown since 2012. Seems like it is growing, albeit very slowly. But it has a hard time going past 0.2 billion. Let's calculate 0.2 as their normal earnings and see what their PE ratio is. So 3.4 over 0.2. 17 PE ratio. Pricey because 17 would be saying, oh, Wendy's is going to go up. They've been growing pretty good in the past. 17 is expensive. Just for perspective, this is the yield. 5.8%. I can get a risk-free for 5%. Not impressed by their earnings, right? PE, I mean, right now. What is their return on invested capital? I'm actually interested to see what this will turn out to be. I'm just going to quickly do it because I have in the past showed you guys how to calculate it. I'm going to be more conservative and not include the prepaid and other. Long-term debt, nope. 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 Yep. 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 Finally, plus properties. Lease assets. Operating lease assets. I'm actually not going to include the financing. Because I'm more doing an operative standpoint. Goodwill, other, not investments. That's okay. I think I could guess what other is. Okay, so the total is going to be 3.4 billion invested capital. And what did we say? We said 0.2. 0.2 divided by total invested capital. Oh, no, that's not what I wanted to do. Oh yeah, 200 million. 1, 2, 3 divided by ants. 6% return on invested capital. Not so good. But that is peculiar. Just to point out, this is only not so far from what their current market cap is. 3.4 billion. Is their balance sheet undervalued? Let's find out. Lettuce. I'm going to actually do the tangible asset value formula, so that's going to be current assets plus properties. Okay. Then I'm going to subtract anything that is a recurring operative charge in their current liabilities that belongs here, not on the cash flow. Yeah, it looks like it. And long-term debt. They have negative tangible asset value. What's their liquidation asset value? Okay, this is their liquidation value. About 1 billion. They're only 3 times their liquidation value. What about working capital? 790 minus 364. This is about about 34. It's about 8 times working capital. Definitely undervalued on the balance sheet. I'm not impressed by their earnings at all. 17 yield is not very good. And they have major competition with McDonald's and their other competitors, like major. And people do have favorites. Like there is definitely direct competition. So since I'm not so happy with this, I'm going to compare finally with operating margin against McDonald's, against Dine Brands, which owns Applebee's and IHOP, KFC. Wait, KFC doesn't have stock. What was the other one? Burger King. Oh yeah, and Jack in the Box. Yes, Jack in the Box. Jack in. I know they have a stock. I've seen it. Jack. Pretty easy to remember. Oh, nope. Jack. There you go. Okay. It goes from 2009. It's all kind of different. McDonald's is in the lead. Restaurant brands. Jack has dipped very down. Wendy's has increased over time, and they do have room for growth. They can still meet the likes of the Dine Brands, QSR, and McDonald's. But Jack in the Box also experienced growth, and they've had a huge dip. But Wendy's has had a long time to get that growth. When were they founded? In 1969. But it looks like since 2016, the CEO hasn't been doing much for their margins. Who is this guy? He didn't even work within the company before he became CEO. He said prior to his employment since May 2016. Jeez, this is not good. He worked with Kellogg. Kellogg had a huge decline. Bad management. No bueno. Alright, let's do a couple more and then we'll call it quits. Oil and gas. Oil and gas. Gas and oil. Oil. Leisure. Okay. Yeti Holdings, I have taken a look at that and it is actually a little undervalued. Fresenius Medical Care AG. Okay. Don't fail me now, Fresenius Medical Care AG. No. Usually the European stocks are not that shareholder friendly. Yeah. I mean, FMS. Oh, 3.4%. I'm just gonna skip around a little bit. I'm gonna look at their net income. Yikes, big decline. But relatively stable. How about the revenue? Kind of stopped growing since 2018. And the rest of the industry has grown. That doesn't make sense. This is no bueno. And its PE is 19. It's unjustifiable. ZTO Express. Patterson Companies. I did already take a look at this. I'm going to try again. Okay, some revenue growth at least. Do they have shares outstanding going down? Kind of. Do they have any dividend? They do. Pretty stable earnings. Except for this, but that was in 2020. I'll give them a pass. What do they do? Oral and animal health customers. They have different companies? No. Subsidiaries? There we go. Animal Health International. Jesus, these have a lot of subsidiaries. Whew. Okay. Competitors to Patterson Companies. Yeah, IDEX. I know IDEX. Yep. Okay, what else? Henry Shane. Yep. Okay, I'm gonna look at their margins. I'm skipping around. I know. But sometimes you're allowed. I'm just gonna look at their revenue first. KDCO, yeah, they've all experienced growth. What's their PE ratio? 12. Where's IDEX's? 48. 25. Lowering operating margin. That's not good. That is not good at all. I'm going to get a return on invested capital, and if it's not good return on invested capital, it may not be a good stock to buy. First, I am going to find a normal earnings. And this will be my last one. I'm going to wrap up after this. Okay. Hasn't really grown that much. This may actually just settle it right here without any return on invested capital. 0.2 is clearly their normal. That shows a PE ratio of 10. Okay. Because they have a $2 billion market cap. Okay. It's not bad. Let's see. Once again, invested capital. We're going to do receivables plus inventory. Not going to do prepaid and other. We're just not going to do it right now. 683. It's okay. We can be a little bit more conservative. Accrued expense. Another accrued. Operating lease. Nope. No, that's interest bearing. That's also interest bearing. And then plus PPE. Plus, yep. No, yep. Identifiable intangibles. Okay. 203, 64. Gonna be doing this. This is 1.2, approximately 1.2 billion invested capital. And 0.2 divided by that is, no, that's not what I wanted to do. There we go. 200, 1, 2, 3, because this is in thousands. 17%. That's not bad, but they just don't have any net income increase. How about their balance sheet values? Current is 1.8. Current liabilities is 1.3. It's like 500,000. 0.5. It's only 4 times working capital. It's only 2 times shareholder equity. This may be undervalued, but it just isn't growing. I mean, if it grew, maybe that would be a different. What's going on with their. I don't look at this often, but what about their cash flow from operating activities? Whoa. What about their retained earnings? Oi. Okay, that's what's going on. Something's going on with the balance sheet where they are definitely. There's not a discrepancy, but they're definitely not making a whole lot of money. Yeah. When I see retained earnings, that looks like this, which is their accumulated earnings. It's not a good sign. 10 PE ratio seems definitely justified. All right. Sorry. With that, I'm going to wrap it up. It's been a little tiring day. But I hope you enjoyed that video. I definitely encourage you to check out some of your own undervalued stocks and look up some stocks that may have less performance than the industry or just less performance in the market in general. It's easy to find those out, especially during today's markets with super high valuations. So, anyways, I hope you enjoyed. We didn't find anything that good today, but we did do a lot of educating on how to find potential securities that are undervalued. So, I hope you enjoyed. I'll see you in the next one. Bye bye.